Today is October the 18th. It's 9 o'clock in the morning. This is the Budget and Finance Committee. My name's Dick Rhodes, and I'm the chairman of the Budget and Finance Committee. Okay, if you would like, if you can, we're going to stand and pledge allegiance to the flag. Okay. Thank you. I declare that we have a quorum, so we may proceed with business. I'd like to call for approval of the B&F minutes for October the 4th. So moved. All those in favor? Okay. We're going to have to take our business out of sequence for reasons that we have no control over right now. We can't introduce our auditors. We're hoping that they will be here later. So we're going to proceed to item number 3.02, which is the acceptance of our financial reports from May through August. The backstory on this is something that I missed last meeting. So we're going to retrospectively, and all we're doing is we're going to approve this for filing. Okay, so, and that we need a consensus for that. So does anyone, let's just go with anyone object. Okay, so we have a 7-0 on this. Thank you very much. Pete, would you like to introduce our speakers for CapTrust?
Thank you, Dick. About a year ago, some people actually on this committee engaged in an RFQ to select an investment advisor. Ann and John were participants in that, and CapTrust was selected. And so just about early September last year is when they took on that role. They are here to give their quarterly presentation, and it's Nathan Erickson and Carol Romney, and I'll let them give a brief bio for the board, for the committee. So,
thank you, Pete. Good morning, everyone. My name is Nathan Erickson. I've been with CapTrust coming up on 12 years. We were formerly MRA Associates. We were acquired by CapTrust in 2020, and I was previously the Chief Investment Officer. So I still do a lot of investment research and work within our office. Collaborate with CapTrust, which is an asset manager with close to $800 billion in assets under advisement. We recently added to our team Carol Romney. Carol's history is as an advisor at Merrill Lynch. She worked in real estate as well, and most recently was a professor at ASU. So very excited to have her. We're going to deliver some market commentary. Carol will talk a little bit about the portfolio, and then Pete and his team have shared with us a number of the questions that have come up over the past couple of months. We've watched all of the previous meeting videos. Carol's very aware of the inflation challenges you see in your budget. And so we prepared some material to address some of those questions. So happy to take questions after market commentary, but then I think it'd be beneficial to let us get through what we've prepared in case we answer some of the questions you may already have. So, just a brief overview on markets. I imagine most of you have investment portfolios of some way, shape, or form. You are very aware of how challenging this market environment has been, and we've got some additional slides later that put that into context. But we're showing here broad asset classes. You can see the shaded bars is the third quarter of 2022. Solid bars are year to date. Real estate on the far left, broad equity markets in the middle four. The bond market, down 14.5%. Depending on who you ask, this is the worst bond market in 80 years, 200 years, or ever. So it's been a very challenging environment. for fixed income, one that we really haven't seen, and probably in any of our lifetimes. There we go. The big driver of the challenges in the bond market, see if I got a pointer here. I don't. Oh, wait, yes I do. There we go. Has been the change in the 10-year treasury. So a year ago, 152, September 30th, or 383, it's actually closer to, it's 4% today. So you've had a 250 basis point, 2.5% move in the 10-year treasury, which is the main reason you've seen losses in fixed income that you have. In other markets, you have losses for different reasons, economic challenges. We're not there yet. It's really the change in the 10-year treasury. We'll talk a little bit more later as to the drivers of that. Is this? No, I'm not advancing. I need some help. Thank you. Oh, okay. Now I got it back. Nice. All right. No, I don't. There we go. Okay. We like to cover headwinds and tailwinds that we see in the market and the economy. From a headwind standpoint, the biggest challenge that the economy is facing is inflation. I think you've all seen that very close at hand, and whether it's within this community, whether you're out grocery shopping, your costs have been going up, and that's been the case across the entire economy. Different areas at different times, and the Fed has made it their number one priority to reduce the level of inflation. Part of the challenge is that one driver is demand, stimulus coming out of the financial or out of COVID, but you also have the war in Ukraine that's affected inflation. Supply chain dynamics have as well, and the Fed really can't control those things. So it's our view that we're going to deal with higher inflation for a period of time. Will likely normalize at the end of 2023. And the Fed's going to continue to address that really on a meeting by meeting basis. Additional headwinds, you are starting to see some slowdown in the economy. Mortgage rates have doubled in the past year. Some of you may have seen that. Home sales have slowed down dramatically as a result of higher interest rates. And consumers are very pessimistic, as you can imagine. And then additionally, we have midterms coming up this month as well, which is, or in November, which can also lead to some headwinds. Although generally the market likes some form of gridlock, not a single party controlling things, then you don't have a lot of uncertainty about what's to come. It's hard to make decisions when you're not all on the same page. So counterintuitive, but that actually works better for markets. From a tailwind standpoint, we are starting to see some things come down. Gas prices in particular, although maybe we're seeing it a little bit less, but the national average for gas prices has come down. The labor market remains extremely strong. So unemployment, I think about 3.7%, and we're still seeing wage inflation. So that's been a counterproductive force from the Fed standpoint. They're not seeing all the signs that they would like to see of the economy slowing. And so they remain concerned that inflation is not yet under control. And then there is an aspect of a contrarian indicator that when people are very bearish, whether it's from a consumer standpoint or an investor standpoint, markets tend to recover in that type of environment. Our chief investment officer at CapTrust likes to say, the market is not the economy and the economy is not the market. So you'll likely see a recovery in the market before you see a recovery in the economy. So let's talk about what the Fed has done. I think this left-hand side is pretty interesting. There's been a number of interest rate increase periods, over the last 40 years, but this is currently the fastest we've seen. The previous two, if you look at this 2015 to 18 and this kind of purple line, 2004, 2006, were much more measured. The Fed would typically do 25 basis points at a meeting or every other meeting. And yet we've seen just a steep, dramatic increase starting in March of this year, up to 3% where we're at now. The expectation is we'll see another 75 basis point rate hike in November, another 50 to 75 basis point rate hike in December. That's already been projected. The market's expecting that. So we'll probably end up right around that 4.25% range. At the same time as they're increasing interest rates, they're also trying to reduce the size of the balance sheet. You probably don't see this or feel it or know much about it, but what's happening here is that, coming out of the financial crisis, they supported the financial system substantially by providing capital to banks. During COVID, they did the same thing, provided capital to the broader economy, and you went from 2008, a Fed balance sheet of $1 trillion to now north of $8 trillion. So that's something that they would like to see come down. And so what they're doing is as their holdings mature, and they mostly own treasury bonds and mortgage-backed securities, they're just not reinvesting that money right now. What that does to the market is takes away some demand that's been there for quite some time. So you've had this consistent buyer in the market of treasuries and mortgage-backed securities that's now slowing down. So that just creates more volatility in interest rates as well. I mentioned housing. Some people have asked, is this going to be another 2008 housing crisis? We don't think so, for a couple of reasons. One, while the mortgage payment has gone up dramatically, you have a lot of people that coming out of 2008 were in a much more stable position. They weren't buying second and third homes with no document mortgages. A lot of people who had a home in 2008 and kept it have substantial equity built up. More what's happening is that, if you thought about selling your home and buying another one, you've probably changed your mind because you realize my mortgage payment will double if I want the same value home. So we're seeing a slowdown in home sales, but you've also got a substantial amount of equity backstopping the valuation of homes. So we don't think any kind of slowdown is related to a housing crisis. I mentioned gas prices. This chart looks at the financial impact of rising gas prices on consumer spending. So as gas prices at the national average measured on this right-hand side go from 3 to 5, that takes a lot more money out of the average person's monthly income. That means they can't spend the same amount on some of the more discretionary items they might have before. When gas prices come down, obviously they have more money to spend. This chart down here, this gray line is the exact same, but inverted. You notice 3, 4, 5 here, 3, 4, 5 down, comparing it to the emotional impact measured by consumer sentiment. As you would imagine, if gas prices are going up, you don't feel so good about that. And as gas prices come down, you start to feel a little bit better because you have more money in your pocket to spend. Last slide I'll touch on here, or maybe two more. I mentioned the labor market. Oh, that's volume. So coming out of COVID, or going into COVID, you see this dark blue line here. This is the labor force participation rate. It dropped dramatically in COVID, and I blame some of you who retired early, who left the labor force and never went back. And we haven't seen a recovery in that number. So that's put some pressure on the labor market. And you can really see it in this right-hand chart. This is measuring job openings versus unemployed workers. So out of the financial crisis, you had lots of unemployed workers, not as many job openings, and it's a net number that came back into balance. But right now, we've got about, call it 7 million job openings. The estimate is something like 1.7 jobs per available worker. So we don't have enough workers to fill all the open jobs that exist. And as a result, this is why you've seen wage inflation go up so dramatically. Measured on this right-hand side, 3% per year, now touching close to 7%. That, as I said before, that's a counterproductive data point to what the Fed is trying to do. What's likely to happen is that as demand slows down for goods and services, the open jobs will come back, will cut back. So a company that might be looking to hire 5 people who sees their revenue slow down because demand's slowing down might decide just to hire 3 or 2. So this will normalize, and frankly, a lot of the inflation numbers will normalize somewhat naturally. It's just going to take time. Probably, like I said, closer to the end of the year, our projections that we're seeing to get back to closer to the end of 2023, 2.5% to 3% inflation. I usually don't touch on this chart, but I think it's important. I like to call it a quilt. I challenge anybody to recognize a pattern here. The answer is there isn't one. Different markets will do well in different periods of time. So we list a number of different asset classes, and the point is, no one can predict what's going to do well from one year to the next. So the best approach is to have a diversified portfolio and own different things that can perform well at different times. Now, the biggest challenge this year, which we'll talk about in a bit, is that both bonds, as we showed in that first chart, and stock markets have been substantially negative this year, and that's not normal, but it is the environment that we're in. So let me stop there and see if there's any questions related to the economic content. Otherwise, we'll go into a review of the portfolio and some of the prepared slides that we have.
We'd ask our committee members that first. Does anyone in the audience have a question that we can pause now and? Okay, let's go ahead and proceed.
All right, I will turn it over to Carol to cover the portfolio.
A little bit, yeah. They never work well. Good morning, I'm Carol Romney. It's nice to meet you all. This is my first time visiting with you all. As Nathan, my colleague, had alluded to, worked in the industry, institutional finance for a couple decades now. Started out REITs on the institutional side, spent some time at Merrill Lynch, and then my latest stint was full-time professor at Arizona State University teaching undergrad finance classes, financial markets and institutions, doing a little Fed watching, and also portfolio finance classes as well. So I have the wonderful job of doing a portfolio review in one of our worst statistical correlated stock and bond markets. So I'm mostly going to do a data dump, and we're just going to look at the numbers, which I'm sure you have already seen. And then my colleague Nathan will jump back in. And I think it's important, especially right now, when we're looking at these numbers, to understand the mechanics behind it, why the numbers are what they are. If you looked at the quilt chart just a moment ago, you would have seen that, let's see if I can go back just for a moment here. I just want to touch on this one here. If you look at my laser, make sure I don't get anybody in the eye. Oh, there we go. Q3, which is all of our data right now, is coming in Q3, end of September. And fixed income was our third best performer this year, negative 14%, but still third best performer after cash and strategic opportunities. And I mention that because, as you all know, this portfolio is heavily weighted towards fixed income, or our bond portfolio, conservative portfolio. We are 90%, and Nathan is going to go over the IPS, but we are within our targets for the IPS. The IPS is developed with the objectives of the committee, and then the portfolio is built towards that. So as I had mentioned, I'm going to look at the data here and just make sure that it's matching, and Nathan will go over the IPS and the construction of it in more detail. Okay, so first part here, these are all the various different types of securities, mutual funds, ETFs, across a broad range of tenures, the maturity of different types of bonds, mostly focused on liquidity, corporate, government, and asset-backed securities, agency securities, I should say. We're 90%. And then we do have 10% in equities, with a small allocation here to international markets, emerging and developed markets. If you want to see this in graphical form, the green is your fixed income or bond allocation. And once again, yes, indeed, we are mostly 90% allocated within that space, diversified across different tenures. And you can see here with our portfolio target allocations the actual allocation and the target allocation there, we are well within the bounds of our target allocation. Lots of numbers here, lots of NAs. I wouldn't focus on that. This is a newer portfolio, so the NA is just not applicable. The portfolio didn't exist since then. So I'm just going to look at what I think is most important, just our year to date. And this portfolio was implemented September of last year. So if you wanted to look at the inception date, we could do that as well. Because fixed income is our 90% of this portfolio. Here's all the various asset classes. These are indexes, so we're not taking big swings. We're not making big bets on this portfolio. We're just tracking an index. So it's not unusual to see it slightly over or underperform a particular benchmark for that particular index. Overall, we are tracking to the ag, which is just a broad-based bond portfolio within our market that tracks intermediate tenured bonds. And we can look at our year-to-date performance, the ag down 14%, this portfolio down just under 13%, so actually doing a little bit better than the ag. Since inception, ag down 15%, and this portfolio down 13%. Again, data dump here. We're going to get into the mechanics of this in a moment. Equity side, only 10% of the portfolio. And overall, if we use the Russell 3000 as our appropriate benchmark, we are overperforming. We're down 23%, whereas the Russell is 24%. Since inception, same thing. The only thing is here on our international, we did slightly underperform the benchmark there. With international securities, it's a little bit tougher. Although they are indexed and tracking to a benchmark, sometimes you will see a little bit more deviation. Overall, when you look at the total portfolio, both the fixed income and the equity piece of the portfolio, overall, we are down 13%, and the total portfolio benchmark would be down 15% for year to date. Okay, so overall, I think this is 1 year short term. When we're looking at long-term performance and income, I hate to focus on this too much, but we are beating our portfolio benchmark. And if you want to know what that benchmark is, it's on the next page here. It's basically weighted by the asset allocation of this portfolio. Lots of numbers. I think it's best to go into an explanation of why the portfolio, especially the conservative portfolios, these conversations we're having a lot of. And I hope with our next segment here, Nathan and I will be able to answer any questions and dispel any unnecessary concerns that you have. But we do welcome your questions and concerns. So I'll turn it over to Nathan now for an explanation.
All right. Thanks, Carol. So let's talk about how we got to where we are today. Pete mentioned, or maybe Dick mentioned, that a little over a year ago, your group went through an extensive process, an RFP, to try to identify an asset manager to manage these assets. They were managed previously by another manager, and so a search was done, and CapTrust was selected. We're fiduciaries, so our only compensation is the fee that's paid to us. It's $58,000 a year, about 20 basis points. It's very reasonable in the institutional world. And we have discretionary authority to operate within the bounds of the investment policy statement. The investment policy statement was designed by your finance committee and approved by the board. So we have a mandate to operate within, and we'll give you some more information on that in a little bit. We do regularly review the investment policy statement. We'll recommend changes when appropriate, but ultimately the committee maintains that responsibility for recommending any revisions, which again have to be board approved. I'm going to point out a few things in the IPS that I think are important. So first, the objectives of the portfolio are to achieve the following over a full market cycle, which the IPS defines as a 3 to 5 year time period. Provide a reasonable level of return given the center's structure and desired rate of return and asset allocation. Avoid significant underperformance of the desired rate of return or loss of invested capital, and minimize the center's exposure to fluctuating investment returns. I will say in the short term, that has been a challenge. There is not a specific level of return identified within the IPS. The objective return is to outperform the benchmark reflected by the asset allocation targets, which is do better than this. And that's what we showed you on the performance report. Again, very short time period, but we're in line with the objectives of the IPS. The IPS also clarifies several points. So the investment return is focused on total return, combined return from capital appreciation plus dividend and interest income. And our objective is to manage within the goal of optimizing the long-term inflation-adjusted investment returns given the investment guidelines. This is important, and I'm going to come back to it when we talk about how we implemented the portfolio. The IPS clarifies that the committee understands that to achieve its objectives, the portfolios will experience volatility of returns and fluctuations in market value. Let me just say, from a governance standpoint and what we see in the dozens, if not hundreds of clients that we work with both in Phoenix and nationally, you have a very strong governance structure. This is a well put together IPS. You have appropriate checks and balances within your organization. So, I think your group has done a very good job in designing this. There's a specific point about diversification. The committee recognizes that broad diversification of the investment assets among various asset classes should help mitigate the magnitude of a loss in any single year. And performance objectives, the committee recognizes the investment managers must use broad capital markets as their basic tools for investment, and a substantial portion of investment returns will not be attributed to management skills, but rather to the market themselves. This is more true with this portfolio than most, because one of our objectives in building this was to keep costs low. The actual underlying cost of the individual investments that we own, the funds that we own, to keep those low. So ultimately, you have, as Carol pointed out, a lot of index tracking investments in the portfolio. The asset allocation targets, as defined in the IPS, are as follows. So we pointed out we have a 90% roughly fixed income target if you combine fixed income and cash, and right around 10% in equities. And we have minimum and maximums that we can deviate from that. So even if we felt like equities are down 20% and we should allocate a lot more to that, the most we could own in equities is 14.9%. So these ranges are pretty tight, and we monitor these on a consistent basis. Every time we get new cash in the portfolio, whether that's from dividends and income or a contribution from the balance sheet, we allocate those funds back to the targets designed in the IPS. So there's a regular rebalancing that goes on, and if not, they're monitored on a minimum of a quarterly basis. This point is important also. The IPS restricts a maximum of 20% in any individual holding. So per the IPS, we can't own more than 20% in any single investment in the portfolio. So let's talk about the environment when we built this portfolio. A lot of squiggly lines here. Basically what we're showing you, because the question has come up, why don't we just invest in treasuries? So we're showing you the treasury par yield curve at different points. Here's what's important. The red line, September 10th, is when we implemented this portfolio. So at that time, if the decision had been made to invest in treasuries, if you went anywhere within 0 to 2 years, you would have earned about 20 basis points on that treasury investment. That would have been locked in for whatever term you chose. So let's say you bought 2-year treasuries, you would have earned 20 basis points for 2 years. And if you wanted to sell those treasuries after a year, they would have been down in value based on what we've seen from an interest rate standpoint. 20 basis points is not in line with the objective of this portfolio. That's not enough return to outpace inflation over the long term. So as fiduciaries, we would have said that's a bad idea. You could have gone out longer to a 10-year treasury, which at the time was yielding maybe close to 1.4, 1.5%. You would have had that return guaranteed every single year with a guarantee of your principal investment, let's call it, $25, $30 million back at the end of 10 years. I don't know that 1.5% is sufficient to meet the objectives of the portfolio either. In addition, treasuries are actually doing worse than the portfolio you own today. Because of the change in interest rates that we've seen from 1.5 to 4 on the 10-year treasury, they're down close to 17% over the last year. That's fine if you're going to hold it to maturity, but it really prevents you from doing a couple of things. One, if you do want to change your investment allocation, you lock in that loss down 17%, you're not going to get your par value back. Two, you don't get the opportunity to make any adjustments to benefit from higher interest rates. So in a world where new 10-year issued treasuries are earning 4%, you're still earning 1.5%, and you will for that entire term. Notice that this treasury yield curve didn't really change until March. That's when you saw the first Fed rate hike. I also think it's relevant to note that the difference between this line at 9.10 and this line, the most recent hike, is about 3%, but the long-term difference is less, about 2%. So there was a question about, well, everyone saw interest rate hikes coming, and I'll talk about the Fed's pace in a little bit, but it's important to note that the Fed only controls the short end of the curve. They can control this number directly. They can raise the Fed funds rate to whatever level they want, but the market determines the 10-year treasury. And what the market is telling you now, by the fact that this line is kind of sloping down, is that the market anticipates rates are actually going to come down in the near future. Sometime probably in the next year and a half. Why? Because the Fed's doing everything they can to slow inflation, and the market is anticipating either a material slowdown or even a recession, at which point the Fed will have to cut rates. We showed you, I'll come back to this, but we showed you this slide before. This is unprecedented, this move in the Federal Reserve tightening pace. Even if you wanted to look at history and say, well, I can tell you for the last 5 years before this year, everybody in the investment industry were saying interest rates have to go up, but they didn't for years. If you looked at history and said, okay, they're going to start the rate hiking cycle, you would have never predicted this. This is a response to the fact that inflation was not transitory. It stuck around longer. The war in Ukraine made it worse, and supply chain made it worse. So I'll come back to that. So let's talk about how we implemented the portfolio at the time. We own a number of ETFs and mutual funds, which is important. One, you can own a treasury security. That's one asset class, the safest investment you can buy with a fixed yield and a predetermined amount of time. When you own a fund, you can't get diversification directly like you can within a fund. So we own in here investment-grade corporate bonds. MBS is mortgage-backed securities. Within the aggregate bond, there's corporate bonds. There's other different types of asset-backed securities. Agency, all different types of securities. If we were to try to do that ourselves directly, you'd need $100 million before an asset manager would do that. So we can't get the level of diversification any other way than using funds. At the same time, you'll notice, by comparison, this is as of September 30th, our portfolio has a yield of about 3.88%. That's over, at the time, the 10-year treasury at 3.83. By using some of these other securities in the portfolio, we can get higher yields. Now you'll say, well, that's not that much higher, but this duration is a measure of the risk in the portfolio. So the higher this number, the way to think about this is it's kind of like a teeter-totter. So whatever interest rates do, duration will tell you what will happen to the portfolio. So on a 10-year treasury today, if interest rates go up 1%, the 10-year goes up 1%, the value of a 10-year treasury will go down 8.4%, assuming it happens overnight. So we have less risk with about a little bit better yield. If interest rates go up, a 10-year goes up 1%, we're only going to be down 5.4%. So in our view, this diversified approach, which again mandated by the IPS to be diversified, we don't have more than 20% in any individual security, and we're able to generate some higher yields by owning some other things in the portfolio. Just a breakdown here of some of the types of securities that you can see: government, corporate. I mentioned agency mortgage-backed. There's a little bit of convertible bonds, a number of other securities within the portfolio. Again, well diversified. I mentioned before, this is looking at rolling periods, so it's not indicative of start date to end date, but you can see the volatility of the 10-year treasury in the dark blue versus the volatility of your portfolio in the light blue. So generally we're taking less risk as indicated by those duration numbers. So let's talk about the Fed and the ability to anticipate what they were going to do. We have a timeline along the bottom that I think is important. We implemented the portfolio here, 9/10/2021. I'm not going to read through all of this, but generally the Fed continued to project that inflation was transitory and they kept rates at 0%. Labor markets were strong. Really, it wasn't until you saw, this meeting right here, which is March of 2022, where they started to raise rates. And notice they went down the path that they had previously, which was a 25 basis point rate hike. So the ability to anticipate what's happened in the fixed income market or what's happened with the Fed funds rate, I just don't think it's possible. We've gotten to this point very quickly, and it's been a challenging environment really for any investor. We showed this chart, I think, the last time we were here, but this just looks at how unprecedented this time is that we're in. This is measuring the first 9 months of each year going back to 1976. Stock returns across the horizontal line, bond returns vertically. You'll see most first 9 months are in this top right quadrant. I've got positive stock and bond returns. You have a few periods where you've got negative bond returns, 1, 2, 3, 4, 5, but generally positive stock returns in those periods, or 6. A few more periods where you've got negative stock returns, but positive bond returns. Only twice since 1976 have you had the first 9 months of the year where you've had negative stock returns and negative bond returns. And this is a massive outlier. Why is it this bad? Basically because we started at 0 interest rates and went up 300 basis points, very quickly. Historically, when you've had rate hike cycles that cause losses in bonds, you're starting at a 5 or a 6 or 7% interest rate, and some of that income is offsetting the loss in the value of the bond. I can tell you if you were to go back to 1910 on this, there'd be one more dot right about here for 1931. Minus 30 something in stocks and a less than 5% loss in bonds. So this is unprecedented times. Remember, our objective is to earn a return over a full market cycle, 3 to 5 years. So we put these last 3 charts together just to illustrate probabilities of success. This column shows going back, again, I think to the same time period, 1970, rolling returns. So what this means is, I can have a year that starts January to December. I can look at another year that starts February to the following January. And so I've got a lot more data to look at there. So notice first for bonds, over a 1 year period, the probability is 88% of the time you're going to have a positive return. About 12% of the time you have a negative return. Over a 3 year period, 98.5% of the time you have positive returns, 1.5% of the time negative return. Over a 5 year period, 99.8% of the time you have positive returns. This 0.2 is us right now. This is the last 5 years that we're in right now. So the longer you invest, the higher the probability you're going to have success. And the committee had an objective to preserve capital at the time. This was a reasonable allocation approach to do 90% bonds and 10% stocks. We believe if you stick to the strategy and stay committed to it, you will find success in the outcome. Stocks are a lot more volatile. It's about 80-20 over a 1 year period, and you can see the depth of losses can be much more dramatic. 86-13 over a 3 year period, about 90-10 over a 5 year period, and 95-5 over a 10 year period. I don't know if you all remember 2000 and 2009, the S&P 500 lost about 1% a year for that entire decade. That was a tough time to be a stock investor. We put these together in your current allocation, again, going back to 1970. A 90-10 portfolio would have positive returns over a 1 year period 94% of the time, 99.6% of the time over a 3 year period, 5 years, never lost money. So I'll stop there. We're happy to take any and all questions you might have about the portfolio. Hopefully we've been able to address some that may come up with some of these slides, but
Thank you. Very interesting. I'm going to open up. We're going to have. I'm sure we'll have multiple questions from our committee, but I'm going to open up with some questions that will kind of warm things up here a little bit, I think. So the first thing I want to say, and I'm going to read this verbatim from our policy so you can understand exactly what the committee's faced with. And this is coming from a policy that it says, the Budget and the Finance Committee, us, shall provide assessment of the performance of the investment advisory firms based on the goals and the objectives of the policy. Okay, so in other words, that's that's your charge, and that's what we'll be evaluating. So we'll be talking about that. After you're done, we'll have a separate conversation where we have to make some type of consensus affirmation that you are or you're not, that we have that confidence here. Okay. So I'm going to start off with a couple of questions. Some of this you've covered, but I think it's important enough that you reiterate it for us. Okay. Sure. So we can hear exactly you know what your response to this is. The first thing is that no individual fund shall exceed more than 20% of the value of the portfolio.
that's correct. Yeah.
Okay,
Yep,
so
we're in alignment with
we
that.
have no, that doesn't exist. It's nothing
Correct.
more than 20%. Okay. Then of course, the no investments are purchased on margin.
Correct.
Okay, the
There's no
answer's
margin.
no.
There's no margin in the portfolio.
Okay. And the fund shall be invested in a range of fixed income and equities with equities not to exceed 10%. So that's the 90-10 that we converted to.
Correct.
Okay, so. That you use high credit investment grade quality and domestic international bonds rated by Moody's, Standard & Poor's, and or on the Fitch rating agencies?
Yeah, so the funds the funds that we use themselves have aggregate ratings that reflect the underlying portfolio, and they're all high quality investments.
Okay. And the final thing that I'm going to ask, and then we're going to open it up, is that investment funds will be guided by cash flow requirements.
Yeah, we've yet to have any cash flow requirements come out of the portfolio, but we are in regular conversation with Pete and Cliff. If cash needs came about, we would be able to meet those objectives. I think what the question is really asking is, the entire portfolio is liquid at a moment's notice. So if you need cash, we can get it to you immediately.
Okay. So I'm going to stop now, and I want to make some comments to the committee. Okay, so this is your opportunity to ask questions, to make comments, to whatever. We'll also open it up to the owners and the folks that are here in the building. But then afterwards, we're going to have a discussion on whether we're comfortable and we feel that CapTrust is meeting the requirements that we have in our own policy. Okay, so that'll be a separate discussion. Okay, so I'm going to open it up now, and I think I'll start with Dr. Miller. David, would you do you have anything for us?
Not really, although the comment was 20% for any individual fund. There is one slide here that does show that we have one thing slightly over 20%, 20.17.
Yeah, and that's actually since this report has been traded down. But you're right. This position right here, it's now below 20%, but at the time of the report, 20.18, correct.
Okay.
So the IPS doesn't specify a timeline, and there are ranges at least around the asset allocation, but when we identified that, we made that adjustment.
That's the only thing I had.
I feel like I've been shot in the mouth with a water fire hose.
I have that effect on people.
I know, that's okay. You put a lot of time and energy into it, and we appreciate that. My takeaway from everything you said is if we were to ask you what should we be doing right now in the economic environment that we're in, it would be to stay the course. Because to make a radical change of any sort at this point, first of all, would require policy changes, which would take a bit of time for us to do. But secondly, there's such an uncertain period of time in the next 2 years that it could backfire on us. And the position we're in, while not the greatest, is probably, based on the circumstances that we're dealing with, the most, the least risk involved. Is that accurate?
Yeah, I mean, the only way you could have avoided this would have been to be in cash until about March and then start investing, at that time. But you still would have had to make some decisions that are in line with the objectives of the portfolio. You certainly can make changes now. We never recommend making asset allocation changes in the depths of a market downturn, because you're going to miss out on any recovery, which is historically, I can go back to those time charts, going to happen. Even if you said, well, we want to take our fixed income from where it is now and move it, to treasuries, your recovery is then limited to the income that you get. So you have duration in this portfolio that, should rates come back down, which again, I think they probably will, maybe not back down to zero, but you'll benefit from that. As rates come down, the value of the positions will go up as well.
Is it correct that we made the switch from 60/40 to 90/10 in March of 2020?
November of 2020.
November of 2020, okay. So if we were to go back and look, you had a number of charts where 2019 was represented. And is there any value in looking at what happened as a result of that, up or down? Before this last period of time, you're almost in a can't-lose situation. So everything looked better than it actually was, probably. But in 19, to make that kind of radical switch, and I know none of us were in, maybe Ann was you were in the position at the time. I'm sure there was a ton of debate, but the intention, I think, was to protect what we had and minimize the risk, because that was the tone in the community, if I recall, correct?
Yes, that is correct. We addressed this as a committee, I believe, in October of 2020. John, I believe you're the only one who was on the committee then, and I know Harry Standenbein, who's a member of the board right now, was on it also. The B&F committee at that time recommended going to an 80-20, and when the board met and voted, after a lengthy discussion, we went to 90-10. So that's what happened. There was a lot of uncertainty. It's hard to remember back that far now, because we've had some robust time in the market, but it still was rather tenuous. And we were looking at our number one objective in our financial policies, which is the preservation of assets.
I have no questions.
Ann?
Some of mine have already been addressed. I guess, and hindsight is always better than foresight. But is there any advice you would have given us about doing something different in the last year since you've had our portfolio? Because we've restricted you in many ways. Our policies were given to you, and you've had some handcuffs on in many situations. And I remember we discussed this when you were interviewing to possibly be our advisors. And is there any sage advice you could give us now?
No, we talked about the basis for the restrictions, and they were all sound in terms of the asset allocation, the restrictions on any individual security. Any deviation, on the security side would not have made a material difference in the outcome. It has been, again, I can pull the slide up again. This has been the most challenging market in 50 plus years. So there's not much you could have done in advance other than holding cash, which again would not have been prudent advice from the committee, from us to do at the time. And we have tried to manage the risk as much as we can within those bounds, both by being diversified internationally within equities, which is only 10%, and being fully diversified within the fixed income. So I don't, again, hindsight's 2020. I'm very confident that we will recover from this. And I agree, I would not make any changes, but I wouldn't have changed what you've done.
Well, I thank you for being candid about that. And as I said earlier, we put restrictions on CapTrust. And we did that because we are being conservative with our investments, and we know that risk and reward are inverse.
Yep.
And we took very little risk because we just didn't want to do that with the funds that our association members have entrusted us.
Mm-hmm.
And I know a lot of people can second guess that, but I think that at the time those decisions were made, they were the right ones to make.
I agree.
Thank you, Nathan, for your time, and Carol, too, for your presentation today.
Mr. Huell?
Thank you, Mr. Chairman. I have 4 questions. So if you feel that is going to take too much time away from others, I could.
I want you to proceed.
But otherwise, I'll get started. And first of all, Nathan and Carol, it was a most impressive presentation for me. Your grasp as an organization of taking a tremendous amount of facts and details from the economy and the financial markets and melding them into a presentation like this is it's staggering. And I want to thank you. It was really, really well done. My question's the last preface, and I promise I'll get started. The last preface to that is my questions are not aimed at any second guessing of what's been done, the investments, how you've handled them, and so forth. I'll try my best to express them as learning opportunities for all of us going forward. So with no further ado, my first one may be shared as far as where the answer comes from, but we basically have lost about 14%. Your presentations has dwelled on the asset value of our portfolio. Have you done any netting with the income that we've earned in that time period that would go as an offset? That's kind of the bond. They throw off cash and minimize your risk. Have you done any netting from that 14% to what our actual 12-month return is?
Yeah, that number is a net return. It does include distributions and income.
Okay, so that's in there already.
Yeah, what I will point out is that the income has increased as interest rates have gone up.
Yeah, sure.
So,
Okay.
I think Q1 was roughly 100,000 in income, Q2 120, Q3 140. So we're seeing an increase in income as interest rates are rising, precisely because these funds can reinvest maturing securities in new investments at higher yields.
Yeah, sure.
That's a benefit of owning funds as opposed to individual securities.
Perfect. That was first question. Pete, do you have anything to add to that would be of help to
His
to
numbers
our
are
owner
correct.
members?
Yeah, the yield overall has increased by about 1%. The annual or the monthly income was approximately $35,000 a month on the bond portfolio. That's in the $48,000 range. So generating close to $130,000, $150,000 more annually with the higher yields.
Okay, thank you. Question number 2, and this is the one loaded with some landmines. Had we stuck with our 60-40, does anybody have, and obviously it's a guess, it's an estimate, there have to be some assumptions and swags thrown into that, but is there even a ballpark estimate of what we would have been looking at and reading right now over the last year's performance?
So I caution in looking backwards. There's really no value in it. A decision's been made, and with great, as Ann pointed out, a lot of discussion and collaboration. I don't know from the period of, because you were 90-10 before we were hired. So there was a period of time where you were 60-40 to 90-10, where I don't know what performance has been. We know last year was a great year in stock markets, an okay year in bond markets. I can tell you, I mean, this is the chart to tell you, if you had stayed 60-40, you know, you'd be down 15%. Or no, sorry. Oh, we don't combine it there. But 60% down 24, 40% down 15, you'd be worse off than you are today over the last 9 months.
I was just curious if you had a number. I have a number, and it's well in excess of $1 million. We'd be worse off. Yeah, and that's fine. I was just looking for an expert,
Fair enough.
and much more objective viewpoint than mine. Okay, my third question, and number 3 and 4, somewhat connected. We have a policy statement, and if we were to, instead of having widely diversified as in funds, but had gone into bonds, the scenario of bonds, we of course would have zero risk. You hold them to maturity, and you have no risk, and in exchange for that, you accept lower return in most cases. And of course, when you're talking about managing other people's money or protecting other people's money, risk is, to me at least, a very large factor. Is the conflict with bonds and versus funds being restricted because of our diversification statement, or the reasonable rate of return?
I think the latter more than the former. You know, there's some gray area when you talk about, find the slide about the 20%, but in any individual holding, you know, is that I can't own more than 20% in a single T-bill? Could I own 10 T-bills? You know, there's some gray area there. You know, the challenge with owning an individual bond is there's no risk if your bond maturity matches your time horizon. So you as an organization would have to decide, are we trying to maximize the yield and therefore go out, you know, let's go back to when we implemented this in September of 2021. We want to maximize yield. We want to get the highest possible return in the safest securities in a treasury. So we're going to go out 10 years and we're going to earn 1.5%. We know that's guaranteed. We know at the end of 10 years, we're going to get all of our money back. If a year later you say, well, we're going to, you know, redo all the greens on the golf course, we need to take some money out of this portfolio, you'd be in a worse off position than you are now. You would have to sell those bonds. So it's only risk-free if you actually match your time horizon to the term of the bond.
Yeah, thank you. I thought you would have the biggest problem with the term reasonable rate of return. To me, that's a blinking word. I don't know what it really means. But again, if you're in an organization like ours where we have a requirement to keep our reserves in a range of 40 to 100% of our fully funded balance, I think it's pretty safe to make the assumption that we won't need some of those funds by policy. So to me, it's almost like an infinite time horizon on those funds, on needing them, and they certainly don't need to be very liquid. Okay, thank you. I'll move to my last question, and then is, with the concept of bonds versus funds, are you driven in your choices by some academic or professional journal publications that show over a wide range of experiences that the bond funds represents a better choice for a community like ours versus the individual holdings with no risk, given the assumption I've told you about? We're going to keep 10 or 15 million by plan. Yeah, so could you enlighten us on whether there are those kinds of studies and whether we should be looking at them Or is that something that's more in your province? Thank you.
Yeah. No,
Sorry for
that's-
being so
That's
windy
fine.
in this.
You know, let me go back to this slide here. So, you know, if there's a concept in the investment industry, and I won't get into too much detail, but it's really, you know, liability matching. If I'm an insurance company and I know I have certain liabilities at a certain period of time, and I can match those with a risk-free security that has a yield that meets my needs, I will do that. So if you as an organization said we have, you know, X amount of money that we're not going to need for 5 years or 10 years, or whatever it might be, yes, we're going to try to identify the safest investment with the highest possible yield that we can. And maybe that's the case. Outside of that, we cannot achieve diversification. We can't achieve competitive yields with less risk by using individual bonds versus funds. I mentioned the yield on the portfolio. So let's assume you had a 10-year treasury starting in September, and that was your fixed income allocation. Your income every month would not change from what it has been, what it started at. You know, 1.5% annually divided by, you know, 12, that would be your income for 10 years. With funds, as rates have changed and positions mature within the funds and they can invest at higher yields, your income's going up. That can't be replicated with individual securities in a portfolio of 30 million. If you had 150 million, we would hire PIMCO or BlackRock to build an individual bond portfolio. They would own all of these underlying positions, and I don't think they could do it cheaper than we are. The funds are extremely low cost. But, you know, then you could say, well, I'm not worried about the mark-to-market loss on this position because I'm going to hold that bond until maturity. Optically, it might feel better. It's the same outcome. So I think you're far better off with a diversified portfolio of managers who can access lots of corners of the bond market and deliver competitive return, again, with, what is that, 40% less risk in the duration, and the ability to adjust, you know, yields as they go up in the marketplace. That's my view.
You've answered my question, and I thank you for that. I regard that as a tough question. Thank you for handling it.
Mr. Bernardo?
Thank you, Dick. Briefly, for the benefit of anyone in the audience who may not know what a basis point is, it is 0.01%, and so 25 basis points would be a 0.25% change in an interest rate. And I'm sure there's at least one person in the audience that didn't know that. Questions that I have first, Carol and Nathan, thanks for coming. I know it's a lot more fun to do these things when you're bringing great news instead of good news. Based on what I see, I think you did a pretty good job of managing our money. Question that I have, Nathan, this goes back to something that you said earlier, that if need be, we could raise cash basically with the snap of a finger from the portfolio. In the event, let's say that that cash were needed in 2 weeks, would we be generating recognized losses? I would suspect that you'd have to take some from each of the funds so that you maintain your percentages. Would we then be recognizing any substantial losses by doing so?
So we report to you market values. So what you have now are unrealized losses. If you took money from the portfolio, whatever money you took would be realized losses. I don't know how that affects your accounting, but on a net basis, you're not in any different position than you are unrealized versus realized. You just have less cash in the portfolio.
I think Pete has something to add.
I was going to
that.
say, last BNF, Frank, you mentioned that it was a balance sheet only. I strongly disagree. Every month we get what he mentioned is the valuation of the portfolio. Our position in the income statement is at the value it is right now. So we're recording that, as he mentioned, in either at this time unrealized. And when you move to liquidate or make a asset allocation rebalancing, all you're doing is just moving it to recognized or realized. There's no valuation change whatsoever.
Understood. The other question I have, and this kind of goes back to what Ann said briefly, in the event the handcuffs that have been put on you folks were adjusted and you had the ability to suggest an asset allocation change from 90-10 to something different, what would you recommend as still a good conservative mix that would be different from the 90-10 that we have now? In my experience in the world of finance, 90-10 is something that is almost unheard of. What can you tell us? And I know that puts you on the spot.
That's a bit of a loaded question. So knowing what you know today, where markets have been, you may try to be a little bit opportunistic. You know, we don't have the slide here, but our CIO we had a meeting yesterday where we pointed out if you back out Facebook, Amazon, Microsoft, Google, the valuation of the stock market is about 12 and a half, 13 times earnings. So regardless of what that means, it looks cheap. So you might be a little bit opportunistic and say, and we could even do this within the constraints that we have. We could go to 14 or 15% equity to take advantage of a cheap stock market. Now, usually you do that because other parts of your portfolio have remained stable when the stock market's down. That is not the case today. Everything's gone down together. So you would realize some losses on the fixed income, but you know, if you had a viewpoint that stocks are going to recover more than bonds will, you know, maybe bonds are up 6 or 7 next year, but stocks could be up 20. That might be something you consider. But that's really, you know, that now you're getting into more kind of tactical decision making. I will say, you know, one difference that we've implemented with some clients is a broader diversification into some non-traditional assets. So there are some things that we've owned for clients that have held up relatively well in the current environment, but they come with a lot of additional caveats. Less liquidity, they can be more complex, more difficult to understand, but you know, things like direct real estate, you know, through a fund structure, or private credit as opposed to public bonds. So you know, we invest a lot of different ways for a lot of organizations. I don't think there's anything wrong with what you've done. It is a healthy exercise to revisit the asset allocation, but I'd go back to, you know, I can't see your name, the gentleman's question earlier. I wouldn't make changes at this moment, but you could reconsider, you know, sometime after you've seen some recovery, to maybe get a little bit more aggressive.
Good, thank you.
Mr. Villo?
Thank you, Mr. Chairman, and thanks everybody for asking great questions, because most of them were already asked. A couple of questions for you, though, for you and Carol, Nathan. Again, thank you. I agree. Thanks for a great presentation. Lots of numbers, and lots of us love those numbers. That's why we're here. Now, tell me, though, we're looking at comparisons to benchmark, right? Would you, as a fiduciary, either, you know, would you recommend, you know, do we have the right benchmarks, any adjustments there so that we can continue to compare, you know, against, and we want to keep the benchmarks, you know, pretty stable, right? Oh, there it is, one more. So any, would you recommend any adjustments there?
No, I think these are the absolute appropriate benchmarks in line with your target allocation. Broad indexes, and we do provide benchmarks at the fund level as well within the report, so you can see, for example, you know, where you've got corporate bonds, we're using a corporate bond benchmark here, so you can go fund by fund and see how they perform, but generally, as Carol mentioned, these are mostly index positions.
Excellent. How are we comparing? I'm not asking you to share anything specific from other clients, right? That would not be good. But how are we faring? Are we pretty much tracking with other organizations or other investments of a similar size and allocation?
Yeah, I mean, the second comment you made is key. There's no value in comparing a 90-10 to a 60-40.
Right.
The asset allocation drives the outcome. Everybody is hurting in this market. Mm-hmm. You know, all broad indexes are down. So I think you're, on a relative basis, actually doing well, because you've got, at the portfolio level, you know, year to date, more than 100 basis points of outperformance. And,
right.
And from inception, you know, 134 basis point, or 1.3%.
Right.
On a relative basis, and that's net of our fee. I think that's good.
Yeah, absolutely. And I'd have to concur with my colleagues here, with Mr. Bagnato, that you guys are, thanks, for managing us through a very difficult time. I wish the numbers were better. I'm sure we all do. But thanks. It was a very comprehensive report. No further questions
Yeah,
from me.
relative outperformance doesn't hit the same when you're down on in dollar values.
Well, at that, it concludes our committee's comments. I do want to make a couple comments before we close out. You say challenging stock market. I hear troubled. We talk about the economy, and we're sitting here looking at the financial impact to Sun City West. I try to reduce that to the simplest form. What did my portfolio do? And for the past several years, I've looked at it and you just have this giant sucking sound when you look at it and you say, oh my gosh. The comfort I have in that is what Mr. Bagnano talked about, is that it's an unrealized loss.
Mm-hmm.
It's a loss if you sell it, and I don't want to sound flip with that. I don't mean to. But if we can kind of steer the course, I think we're in some very, very stormy economic times. I particularly liked John Hobald's comments about, well, what if we would have not changed to the 90-10 to the 60-40? Well, you couldn't really comment on that, but I can surmise that it would probably be a lot worse. Now, I don't have any data to back that up other than my own experience in looking at the stock market and comparing the risk analysis of a bond relative to an equity. And if I were 30, I would be much more excited about going to a 50-50 or maybe even a 40-60. But when we're looking out for the capital preservation, and our charge is to look for capital preservation, which means low risk. That is exactly why the governing board decided not to go with the recommendation from the finance board, the B&F committee, but they were even more conservative, which is actually paying off, even though we do have these losses to the 90-10. So at those are just editorial comments. I'm not asking you to comment on that at all. So I thank you for your presentation. I think you have been very professional, and I think you've been very thorough, and we appreciate your time in coming here today to help us. So
Yeah, you're welcome. And the only comment I'd make is to Mr. Bargnano's point. I mean, this is 10-year plus money. Hopefully you don't need to tap all of it or most of it at any one moment. So the probability is highest that you're going to have somewhere in the 5 to 10% return over that time period. And the longer you go out, the probability just increases that that's where the returns are going to be. And I think that's in line with your expectations.
thank you. Oh, yes, excuse me. I do want to open this up now. Thank you for reminding me. I do want to open up, if we have anyone in the audience that would like to ask a question of CapTrust, this would be the time. If you would come up to the microphone, identify yourself and your rec card number, please. And I think we have a timer.
Good morning, I'm Kevin Brooker. The 2 minutes is always tight. Apparently I like to talk too much. 132101 is my member number. I want to go back to the 20% not to exceed any holding. And where I'm stuck isn't the essence of that to basically say don't put too much money in one basket? Because what I'm getting at is the aggregate bond funds. That seems to me, isn't the Fidelity Bond Fund, iShares Ag, and Schwab Ag, they all have the same duration, same yield, and virtually identical portfolio characteristics and performance characteristics. So how does that benefit the portfolio when you have overlapping funds that are benchmarked to the same ag bond index? So I'm not the smartest guy in the room. That's why I'm asking you to help me figure it out.
Yeah, so I mean, frankly, we had this conversation, with the committee early on, the aggregate bond fund is extremely diversified in and of itself. And without the 20% restriction, we probably would own one of those positions, and it would be more than 20%.
So is CapTrust positioned that this bond, the bond portion of the portfolio will exceed, for instance, 2-year treasuries at 4.4? I've been the guy arguing to go to individual issue bonds. So 4.4, are you feeling that the ag bond index is going to outperform 2-year treasuries at 4.4?
At this moment, the ag's yielding probably close to 4%. You can sell the entire portfolio and own a 2-year treasury, but you've locked in your loss at that point. And had you bought a 2-year treasury when we incepted this portfolio, you wouldn't be earning 4.4, you'd be earning 20 basis points.
Well, that reminds me of the Will Rogers that I'm more concerned about the return of my money, the return on my money. If we had done that, we wouldn't have lost anything, though.
But the,
So you're
the
right.
current portfolio does have a higher duration. So if interest rates decrease from this point and I own a 2-year treasury, my return is maxed at that 4.4%. I'm not going to benefit if rates go down.
No, I understand that. I'm trying to avoid the loss, is what I'm trying. I'm trying to avoid a principal loss. So is CapTrust
The
position?
loss is already occurred.
Could I ask, because I think we might be talking a policy issue here. So it's your position that the individual funds are treated separately as one fund, and then even if it's a similar fund, it's still within the 20%. That's a policy issue, and I think it's something that we would have to address on the board if we felt that that was appropriate.
No, I agree. I'm just trying to bring attention to it.
Thank you. Thank you.
Can I ask one more question?
One more.
All right. There's some research that just came out in Market Watch last week from the London School of Economics in Cambridge. They cited research that shows long-term treasuries have more risk than equities, going back 100 years, not 50 like the chart you showed. They cited the period from 1924 to 1971, how bonds on an inflation-adjusted basis lost money in that entire 57-year span. Whereas 71 to now, we've been in a huge bull market for bonds, right?
Sure.
So in a rising rate, does CapTrust feel rates are going down over the next couple of years?
Well, I mean, we're not in the position to predict rate movements. I think the market is telling you, because you have an inverted yield curve, that there's a high likelihood that short-term rates come down in the next 1 to 2 years.
Thank you. I think that we need to bring this.
Okay.
Thank you
Fair
very
enough.
much.
I appreciate it.
So I want to, do we have others in the audience that would like to ask a question? Please come up and identify yourself and your rec card number, please.
Hi, William Huff, and I'm on 121-677. I got a question as to the overall economy. Do you see any risk to the food supply? I've been reading a lot of things about risk to the food supply.
Yeah, supply chain has had an impact on that. So getting shipping containers unloaded at ports has been a challenge. I think some of that is easing. I haven't seen broad concerns that the food supply as a whole is in dire straits, but the fact that you're seeing inflation when you go to the grocery store will tell you that it's harder to get some of the same goods that you used to. I think the general view is that will ease over time as the supply chain improves.
Okay, thank you.
Thank you. Are there any other questions? Okay, thank you very much. We appreciate your time.
Thank you.
So the next item is actually going to be a discussion with the committee regarding CapTrust performance as our investment advisor. So I'm just going to open the floor to anyone who wishes, any of the committee members who wishes to comment on that.
Well, I'll go first, and I will say I was one of the people who put them in the 90-10 position, and whether that was right or wrong, I think they are doing what we have asked them to do. Now, the question may be, should we be asking them to do something different? But the only thing that they haven't done is something that I don't think we have pushed them for, which was to provide education to the governing board and the BNF committee. I think the BNF committee gets somewhat of an education from them in these presentations. And I think those on our committee understand this better than the general board would. But I think it would behoove us to have a session with the full board and the BNF to pursue more education on these points. Thank you.
Ms. Novello?
As you had said, we're looking strictly at the policy that's in front of us, right? So based on that policy, I see no reason to be concerned. They seem to me to be adhering to our policy. The question before us, you might be alluding to, is do we want to make changes to that policy? And that's something that we will discuss at a different time. So.
I've always been impressed with their grasp of the issues, the environment that they work in. I think they have a very good understanding of what Sun City West is all about compared to other clients that they might work with. It's been a very short period of time. I would wholeheartedly suggest retaining them.
Do we have any other comments?
I'm trying to formulate my thoughts here. I think, yes, they did a wonderful presentation. The questions that everybody asked were really great and added a lot more in terms of education. And just reviewing their report, I think, as you all have said before me, they have adhered to the policy. And the other thing that happens, because we're going to be going into a budgeting period, I think we leave with a better understanding of the reserve, the effects of the market, and the impact it is going to have on whether or not we're going to draw cash or need to draw cash from the reserve fund, which would in turn affects what we're going to be looking at when it comes to budgeting and budgeting for capital related items. I think the market, I think that's what they've demonstrated very well, the impact and what we're going to have to take into consideration when we're looking and approving different capital budgets and the budget in its entirety. And I think going forward, we're going to have to keep close track on the market and our investments and what they're doing. I'm new to the board, this committee. How often do they come in and give a presentation? Is quarterly? Oh, good. Okay, thank you.
Mr. Schwind?
Thank you, Chairman Rhodes. Bill Schwinn, and I just want to give a couple of comments here, taking a step back. I want to talk about when a year or so ago, when Ms. Brown was chairing this committee, we did have and went through a fairly extensive process bringing in fiduciary agents that could help us in this area. Mr. Hobart was on the subcommittee as well, and a lot of thought went into that, a lot of energy. And these folks were selected for several reasons, but they are very good. But one of the things I think that really stuck out was the fact that they are local, and they are here at our side, when needed. So that was a big asset as far as I was concerned. But again, I just want to touch on just a couple of things. There is an association out there called the Community Association Institute, which we are members of, and they provide a lot of industrial knowledge when it comes to how HOAs function. Now, we are a gigantic piece of property here. You're not going to find too many Sun City Wests around the nation. There's one in Florida that I think got swept off the map a week or so ago. But we, Sun City, and a lot of the Del Webb communities around the nation can operate, but we don't all operate the same way. All of you on this committee, I'm sure, invest money, which is your money, and you are absolutely free to do whatever you wish with that. I do the same. But representing an association, we got to be very, very careful because it's not our money. This is association money, and we have to be very careful with that. And that was really the lead-in to getting back to policy, and that is to protect our assets, right? Let's be safe. Let's be smart about this. We can certainly invest. We can go to Vegas tomorrow, and we can bet on some ball games too, make a little bit of money, but I'm not doing that with association money. I do that with my own coin. So we want to be really, really careful as far as what we do and be conservative. So there are associations out there that do not invest. That, but there's no law that says what you have and have to do. That's policy. And I think the governing board went through a very strenuous effort with this committee a year or so ago and came up with what we currently have now that is considered conservatively safe. You can argue left and right, what's wrong, and what you would do with your money. But under the concept, I think that we're operating, it's other folks' money, and we are very, very careful with it. Thank you.
Very well said, and we are very keenly aware of that. This is not our money. Do I have any other comments from the committee?
Yep, Mr. Chairman,
Mr.
I hadn't made any, but a quick one. To your question, I believe that CapTrust has done everything we've asked of them, and they've done it very impressively. One thing I would like to maybe throw out for consideration in the future is we have audits and governance over all we do internally. I'm wondering if it would be in the community's interest somewhere along the line to extend some kind of audit on this $27 million that we have stashed with them. I'm mindful of a few frauds that have come up over the years. Bernie Madoff being a name that we might all recognize, although who would give their money to a guy named Madoff? But nonetheless, I just wonder if it would be in our interest somewhere along the line to send the internal or the auditors in to just make sure. It's just food for thought. Thank you.
Thank you. Any other comments? Then I think we need to, yes, what, Susan?
Oh, yeah, to John's comment, we do have our external auditors coming in, and perhaps we can ask them what auditing procedures they use to verify the value or, the dollar amount of our assets that are in this portfolio. Thank you.
Okay, if we've had sufficient discussion on this, I think we should go ahead and to make a recommendation. So I'm going to start with one. The B&F committee recommends to the board that CapTrust annual performance is in compliance with the goals and the objective of the Rec Centers of Sun City West Policy FI 12. Okay, so do we have if we could get consensus on that? All those that feel we reach consensus?
I concur.
Yes.
Okay, it's unanimous. It's a 7-0. Okay, so the Finance Committee has a reputation of our meetings going longer than we really expect them to do. We still have one presentation from CLA for our independent audit, and we still have 3 policies that we will review today. I am going to declare a 5-minute bio break so we can prepare ourselves to come back and focus on the audit and finishing our policy reviews. Okay, thank you. Okay, folks, welcome back. We still have items on our agenda, and we want to give them the attention and the diligence that they're due. So at that, the next item will be, we've actually taken it out of sequence, the CLA audit presentation. So Mr. Finelli will introduce our presenter.
Thank you again, Dick. We've been with Clifton Larson Allen. I have a lot of people that ask. We use the acronym CLA so frequently that sometimes I forget. But Gene headed up the audit this year and has done in several years before with different clients, or excuse me, different associates virtually every year. Her specific title is signing associate. And it's Jean Dietrich, and she'll be presenting today.
Thank you, Mr. Finelli, and thank you, committee, for being flexible with my issues in arriving on time today. I appreciate that. My name is Jean Marie Dietrich, and I was in charge of the audit engagement for recreation centers of Sun City West, Inc. for the years ended June 30, 2022 and 2021. I do want to let you know that management was ready for the start of fieldwork, easy to work with and responsive to our requests. Our risks in performing the audit were management's override of controls and improper revenue recognition. Our response to that risk was to obtain an understanding of your internal processes and controls in place, test manual journal entries, and sample and verify revenue transactions. And as an additional element of unpredictability of the audit, we also took a deep dive in ancillary revenues, such as your point of sales and your bowling income. We really put most of our efforts in your big dollar items, but to give management a turn at some unpredictability procedures, we took a deep dive in your ancillary revenues this year. One thing to note is that the opinion is going to look different if you were to compare this to the previous year. That is because we had a change in auditing standards. With that change in auditing standards, the standard setter said, what matters to you most is the opinion. So that's what's first on the page. I don't know how to scroll down on this. If you could just scroll down. So that the top of the page is our opinion. So I'm pleased to let you know we're giving a clean, a modified opinion on your financial statements. That's followed by responsibilities of management, and then our responsibilities. And when we perform an audit in accordance with, how do you scroll this thing? Thank you. There we go. We exercise professional judgment and skepticism. We identify and assess risks, and we obtain an understanding of internal control relevant to your financial statements and evaluate the appropriateness of the accounting policies adopted by management. And we also conclude whether or not there is substantial risk about the entity's ability to continue. With the balance sheet and revenue streams of Sun City West, we have none of those concerns. First is your balance sheet, which is the listing of your assets and liabilities of the association. Just a couple of highlights. Your operating cash increased about $1.3 million during the year, with reserve cash and investments decreasing about $1 million. And also that's offset by capital assets increasing $1 million for an overall decrease when compared to 2021 of $1.2 million in assets. Your liabilities have remained relatively flat with some fluctuations in deferred revenue and accounts payable. And overall, your members' equity increased $1.3 million due to your current year income. That income was due to an increase of $800,000 in your revenues, specifically revenue recognized for membership dues and asset preservation fees increased. You have an increase of asset preservation fees that have been recognized, not necessarily collected, but recognized during the year. That is offset by an investment loss, both realized and unrealized, of $3 million versus a $2 million gain in the previous year. Expenses increased about $2 million. This was mainly due to some catch-up on some maintenance expense, $300,000 of depreciation expense, and personnel expenses of about $363,000, resulting in your overall excess of revenues of $1.3 million for the year. For your cash flows, the operations of the organization, the association, is pretty strong. You tend to have positive cash flows from operations. For the year ended June 30, 2022, you had about $9.2 million of cash flows from operations, about an increase of $330,000 when compared to the previous year. Cash used by investing activities were those purchase of investments and the sale and redemption of certificates of deposit for a net of $2.5 million, offset by a purchase of capital assets of about $5.4 million. Overall, net increase in cash and cash equivalents of the year of $1.3 million. Your statement of cash flows is followed by your accounting policies of the organization. It's a fairly significant note describing all the policies, including revenue recognition and how you measure the fair value of your investments. That is followed by note 2. And just to respond to the previous question, when we audit investments, our first step is to confirm with the third party what your balance is at the end of the year. In order to determine if the fair value is sufficient, we also look at third party, whether it be going through a SEC exchange or a broker or a valuation, what your assets are held out if we would agree with that valuation at year end. We do not perform tests of purchases and sales throughout the year, but to be comfortable with that value at year end, we do sample individual investments and check them to an independent verification of value. Your receivables consist of membership dues and related party dues from the associated charter clubs. And those receivables are fairly consistent with the prior year. Again, as discussed, note 5 is going to be your disclosure of your property and equipment. That increased with $5.4 million of capital purchases, offset by $4.2 million of depreciation expense. Note 6 is your concentration of risk. It's a disclosure that all membership dues and receivables are really coming from one geographic location, and it's just a disclosure of that concentration of geographic location risk. The association does have a defined contribution savings plan. There's been no changes in that plan in the current year, and matching contributions and profit sharing of $420,000, which is consistent with the prior year, was expensed in fiscal year 2022. Note 8 is your disclosure regarding your future major repairs and replacements. And then followed by note 10. Note 9, your commitments and contingencies. This is just regular disclosures that in the normal operations of an association this size, there are incidentals that are occurring, but nothing significant enough to be disclosed in these financial statements. Note 10, coming up is a significant accounting standard. That is the lease standard, that if there are any embedded leases, service leases, or operating leases or capital leases, a asset, right to use asset, will be offset by a lease liability. Management is evaluating this new standard. It has not deemed there's any impact at this time. This is your supplementary information on future major repairs and replacements. This is an unaudited schedule. We are not actuaries. We are not fair value determinants of what your property is. So we take your, take management's study, we make sure that it's consistent with the study itself and the disclosure, and that the fund balance agrees to the audited financial statement numbers. Though that, as presented, is the audit of Sun City West, Recreation Centers of Sun City West for the years ended June 30, 2022 and 2021. I'd like to just move on to our required governance communication. In performing an audit in accordance with auditing standards, we identify significant risks. Again, the two risks that we identified was management override of controls and improper revenue recognitions. We came up with our risk assessment and our planned audit scope. We had no changes in this planned audit scope. We noted that management had no changes in their accounting policies during the year. Management does arrive at certain estimates. In completing these financials, those would include an allowance for doubtful accounts, the reserve for the future major repairs and replacements, and the amortization of deferred income over the membership life. In reviewing those estimates, we found them considered consistent with prior years, and we did not identify any management bias. We had no difficulties encountered in performing the audit, no disagreements with management, and we're not aware of management consulting with other accountants, what we would deem opinion shopping. We're not aware of any such conversations. There were no material adjustments posted and no past adjustments. There was an internal control communication with the size of the association and what they're willing to budget for a finance team. I think your finance team has really improved controls in place, and they continue to do so. We still feel that there's a more robust review process on schedules that can occur, and management is documenting and moving forward with improving those segregation of duties and improving the audit trails of the schedules. There was a error in following the investment policy when the changeover occurred to CapTrust. That was because the certificates of deposit that were purchased were under a different policy, but that has been rectified going forward. We identified no irregular transactions or fraudulent transactions, and I welcome any questions on the audit as presented.
Thank you. I do have a question, and I'm sure that it's just something that you can easily explain. On page 18, the last paragraphs, the board designated assets were adjusted appropriately, and the fully funded balance as of June 30th, 2022 is estimated at $51,564,406. Does that coincide with our, and maybe this is a question for Pete, does that coincide, Pete, with our number?
That was a good catch. The 60% is about 5 to 6% higher than what we report. The denominator is the issue in question. That's the FFB of CapTrust, excuse me, CLA, sorry. CLA requests from our outside reviewer. DJ Blaming is the representative, and the name of them is Association Reserves. They perform their review after our books are closed no differently than they do in terms of performing our audit. And so the only one that was presentable to them was the one from the prior year. So you extracted that number, and the 51 million creates a lower denominator, so the 60% is increased. I present to you guys virtually every opportunity, as did Cliff during the reserve fund and reserve study explanation presentation, that in fact those increases have increased quite a bit in the last year. So our denominator is now in the $55–56 million range, and yeah, that's where the 54% comes. But CLA wouldn't have that. They just get it from our last report from Mr. Blaming.
Thank you. I just, it was a red flag. It jumped out that 60% was not the number because we haven't been talking about 60%. We'd like to be talking about 60%, but we're not. Thank you. Does the committee have questions? Okay, Susan?
Okay, thank you. I have one question. It's a very excellent report. In comparing the audited to the internal statement for the same time period of June 30th, 2022, I was very impressed because they're both in agreement with the exception of one number. And that had to do with a replacement fund reserve on page 7, 225,000. 261. My question is, what was that? What was that? And will it be recorded on the internal statement for this time period?
It's a very good question. 2 years back, sorry, one more year back, the FASB, the Financial Accounting Standards Boards, issued a standard called Revenue Recognition, Topic 606.
Oh, okay.
Okay. As a result of that, the equity in your reserve fund changed from equity to a liability, a deferred revenue, an unearned income.
Okay.
And so those, the asset preservation fees are now recognized when those expenditures occur.
Gotcha. Okay. So this was bringing the audited statement into alignment with what we have on the books
So
here.
on your books, you'll see it as an equity, a fund balance. On the audited, it's a financial statement presentation, that it's an unearned income. Anything you would want to add to that, Pete? No, good, good.
Thank you.
And
Thank you very much, Jane. I appreciate the magnitude of what you have done again and the report. I just have one question regarding our investments. Is there anything you think we should direct you to do differently?
The one suggestion, and I really did enjoy CapTrust's presentation, and I really appreciated Mr. Schwinn's remarks as well. Just explaining the balance sheet effect and the unrealized losses, one thing to keep in mind is this committee does have the opportunity to adopt a different accounting policy in regards to investments held to maturity. So if you do go that route that you would change to purchasing bonds, I'm not implying anything's better or worse, but there is a change in accounting policy that could happen where you would recognize those bonds or certificates at amortized costs, where you wouldn't recognize those at fair value if you had identified something where you did identify, say, $10 million that you were going to hold for a period of time and hold those investments to maturity. Those accounting policies are available to you through GAAP.
Okay, thank you very much. Thank you very much.
any other committee members? You have done a very nice job. Thank you very much.
Thank you.
Very, very thorough. You know, we do appreciate that. Of course, you've consistently been very good too, so thank you. Okay.
Thank you
Oh,
very
do we
much.
have questions? I'm sorry, do we have any questions from the audience? Anyone would like to make a comment or have a question? Thank you.
Very much.
Oh, Pete?
Just
Yes.
gonna ask you, maybe, unless it's part of your future, we talked a little bit there. The agenda did not have the recommendation added to accept the audit into the governing board, so maybe you could speak to that, yeah.
Yeah, thank you. Thank you. That's actually my next next topic here. We do need to make a recommendation. First of all, if any of the committee members have any questions or comments that they want to make about the audit. Okay, we're going to be required to make a recommendation to accept the Clifton Larson Allen audit to the governing board. So at this time, I'm going to make a recommendation. The B&F committee recommends the board approve the FY 21-22 Clifton Larson Allen audit per Rec Center of Sun City West Policy, CO3, subsection 1.2.5. In other words, are we satisfied with this and we want to forward it? Okay, so we have consensus. We have a unanimous consensus of 7-0. All right, now we're going in to roll up our sleeves and we're going to do some policy review. So the first policy review will be FI10, and that one is for Mr. Bosak. FI10 for Mr. Bosak.
Thank you, Chairman. FI10, for those who don't have a copy in front of them, is the procurement policy. And like most of these policies, they've been scrubbed for many, many years over many different groups. So there's not a lot of change in this one, but I did want to just take the time so the committee understands what this gets at. In our case, we were able to identify and coordinate with Bill's staff, and they did a wonderful job of supporting the conversation we had around both of these policies. Pete, Cliff, Terry, when it comes to 13, Riley and Deb Long, 2 different sessions, thrashed through all the information, came to a conclusion that a couple minor changes were made. But as far as the procedures go, every one of the managers has the responsibility for making sure that the departmental procedures are adhered to. So the 4 majors are Russ, Todd, Carl, and Pat. And in the case of Russ and Todd, they each have a person, because of the extensive nature of their purchases, that does this activity. In the case of Carl and Pat, they do it themselves. And then from a community standpoint, they have an individual named Dave Kingery, and he's kind of the coordinator, in my view, to make sure that someone isn't paying more for toilet paper than they should. And so he kind of coordinates the activity of purchasing for all Sun City West. So at any rate, the policy itself, you see there's a red line on 2.1, second paragraph, eliminating gas. And the reason we did that is because gasoline really isn't a very good example of something that could be purchased either as an individual item or in multiple locations. And the way the sentence reads, it implies that it's only for recurring and not the multiple. We eliminated it. It's really innocuous and nothing to get excited about. If you go to the second page, you'll see the chart that you've seen many, many times before, and those are the authorized amounts of purchase that are required at the various levels. No change in that, but there is an element that we're going to get to that I'm going to refer back to that at the very end, so if you just kind of hold that in abeyance. The exemptions to the bidding process, there's no change there, but again, just so we all understand what it means. The sole source justification, there's only one item that has come up on a number of occasions where we use a particular vendor because they have a unique ability to provide a product, and that's well pumps. And when Todd needs one, he needs one, or things are going to get really havoc on that golf course. So that's about the only one that anybody could come up with. The emergency procurement situation is always approved by the general manager or the governing board. And again, that's reflected up in the dollar amounts above. And the professional services would be the attorneys, for example. So those approval processes, whether they be the general manager, the governing board, or the CFO, there's a very strict compliance in place, and we have no reason to believe that that's being violated or should be changed. Section 4, there's a lease or rental agreement. This came into play a couple times in the past year, where all contracts exceeding $50,000 or 1 year in length had to be approved by the governing board, and both of those were done. Number 5, the non-budgeted items, the association bylaws, we simply added the association bylaw specific, so it better defines where that information is found. 7.3.1.5.3 is a red line addition. Here's where the possible question might come in, where it talks about the budgeted emergency repairs to the association facilities could be done up to 1/4% of the preceding year's fiscal total gross revenues. That in fact could be $60,000 or $70,000 based on the current level, which would appear to be in conflict with the $50,000 earlier point made that the general manager has subject to. But the difference is it's an emergency and it has to be done immediately. So that's why that's in place. It is a bylaw. To change that would require a bylaw change. We didn't even want to get into that conversation, so we left that sit as it is. The last point on 6.2, it's nothing, no change, but just for your information, that reads exactly like it is worded in the employee handbook. So there's no need for any change in that, but it does reflect and is co-joined in 2 different places. And that's really, as we went through these, we wanted to make sure that everything lined up in the right place, because there's a lot of this information appears in different places, and I think we've been able to do that. So in spirit of time, I'm done with FI10. I would only want to make one more comment about FI13. This group of people that I thanked and mentioned earlier spent a great deal of time, hours, thrashing through the collection policy. No, I know we're not, but we're done. I'm done with 10, but I also had responsibility for I-13. No, I know we're not going to do that today, because there's some significant incidents that are being investigated from a legal perspective, and our red line version, which was created, is probably going to change again. So we'll come back to you with F13 after it's been vetted by the powers that be.
So in summary, there are only 2 changes to this, and that's a red line, and it's on paragraph 2, actually 2.1. It's it will delete in the for recurring items, and then it deletes such as gasoline. So we'll delete that. And then the other is an insertion of a reference to the association bylaws. It's the actual reference to Article 7.3.1.5.3. Okay, and that is in toto that you, okay.
Powerful analysis.
Thank you.
Thank you.
Let's deal with all of these at the same time. So next will be FI15 on preparation of annual budget plan. Mr. Miller.
Thanks, Chairman. In going over this, I really didn't see a lot of need to suggest any changes. I saw one opportunity that I wanted to bring to the committee for their consideration, and that's in number 3 under guidelines. All of us that have done budget preparations over the years know that there's a lot of different ways to do budget prep. You can do by organization, you can do simple escalation based on inflation. We give the power to the general chairman to determine the methodology, but I never saw that that methodology was actually ever communicated anywhere. And it would seem to me that that would be, in our spirit of trying to improve transparency, that would be a simple report out by Pete or whoever to the committee. You know, I'm not looking for something that's a tome. I mean, this strikes me as a single-page PowerPoint that says this is what we're going to do this year. And I started thinking about it from the point of view, you made a comment at the last meeting about, you know, industry practice standards escalating for inflation. Well, you know, if we escalate for 3% this year, given the climate we're in, we're automatically going to be in a hole. So if we ever needed to deviate from those industry standards in planning for the next year's budget, it would be a good opportunity to know that ahead of time. So I would simply suggest that we consider adding this one statement, that we get a report about what the methodology is going to be.
So let me read that, the suggestion that Dr. Miller has. It would be inserted after the very first sentence of paragraph 3.0 guidelines. The method for development of the budget shall be communicated to the governing board via the Budget and Finance Committee. Now, we should have discussion on this if we believe this is Ann?
Thank you, Chairman Rhodes. The general manager, as I understand it, will still determine that methodology. Okay, I can follow your step here, but I wonder if we're doing anything unnecessary. Could it not be incumbent upon, I think in the past, the general manager has shared the method when that's been communicated to the board, when the budget has been presented. So we're just adding a step in here that says Bill Schwinn comes and says, I'm using this method. I don't think we have to approve that or disapprove that, but then our chairman has to go to the governing board to say this is what's going to be used, instead of the general manager communicating directly to the board.
Well,
Is that,
okay, it's not clear from this procedure that the general manager comes and communicates his methodology to the board, or from this policy statement. Perhaps that's already being done. In my conversation with Dick, when we talked about this, I suggested, well, maybe that's being done, I'm just not aware of it. Okay?
I don't know that is something that is formally set up, but I know, given the governing boards I've sat on when budgets have been presented, he's been scrutinized as far as the methodology
and
that's
that's
used.
a perfectly fair comment.
So, but if we need to have something because we think something should be done and isn't being done, I'm just wondering if we're putting an unnecessary step in here. And I understand where you're coming from, David.
Yeah, no, I don't know that it's necessary or unnecessary. Again, I kind of approach it from the tone of the prior committee meetings, where again, we talk about transparency. And it's all well and good to know somebody's going to come do something just because it's the right thing to do, but sometimes people don't always do the right thing. So again, I mean, I look at it, again, given the amount of, how should I put it, tension that's been in the air over the budget development for the last couple of years, anything that we can do to improve the transparency and reduce that tension, I would be supportive of, which is really what the genesis of this comment was.
Okay, I'm just kind of trying to digest it because the budget is presented before it's voted on by the governing board in May. It's presented probably 10, 12, 13 times. And all of those, I've always heard the methodology used, but that's not to say that a new general manager would do that. But I think those questions would be asked. But I'm just throwing out my comments. Thank you.
Ms. Novello?
I think it's actually perfect comment based on what Ann was just saying, that this is happening now, right? And but I think we're building this into a policy. I believe we would be building this into a policy that it continues. It's good practice, and I'm in support of the concept. I do agree with you though, Ann, that we don't want to add unnecessary waste, meaning wasted time, additional complexity, but it's just really reinforcing. So if there's a way to, simplify this so it doesn't imply that someone needs to come here and get approval, as long as the methodology is included in what's presented, I think that's the spirit of what David's trying to say, and I would support that. I'd also support, Ann, the fact that we don't want to add more complexity than we need.
Yeah,
So-
I'm not requiring or suggesting that the general manager needs our approval for whatever method he's using. I mean, that's not what that says. It's simply, please tell us what you're going to do.
Yeah, just
And that's
include
all
that
I'm
in the
asking
statement. I would support that. I think, again, it's happening now, but it's a matter of, it ensures that full transparency and so forth. So I'm in support of the concept.
Ann?
Thank you, Chairman Rhodes. One thing that I learned early on as I came onto the Budget and Finance Committee before I was even on the board is the budget is the general manager's budget. It is not the Budget and Finance Committee's budget. It is not the governing board's budget. It is the general manager's budget. And so I'm wondering if we should put the general manager shall determine the methodology to be used for developing the annual financial plan and share this method with the Budget and Finance Committee and the Governing Board. Have put, the onus is on the general manager to share. I think we're putting an unnecessary step in here. It says the general manager comes to BNF. BNF takes that information. It doesn't say that we have any say in whether that's the right methodology or not. That says then BNF has to take that, and then BNF has to go to the board. I'm thinking we can just streamline that and
And I would be completely in agreement with that. I mean, I'm not trying to add layers. I simply want the methodology communicated.
And-
The way you phrased it is much better than what's written up there.
Well, thank you, but,
Okay.
and I agree, the methodology is important to that budget, but I also want to give leeway to our general manager, no matter who it is, because we have identified that it is the general manager's budget.
Right. I have no issue with that whatsoever. The way you phrased that was very good. So hopefully you can remember what you said, or
Well,
we can play the video back, so.
And could you go ahead and rephrase that, or?
I think if anybody wants to write this down as I speak.
Okay, I'll do it.
General manager, I'm going to leave the first sentence there. The general manager shall determine the methodology to be used for developing the annual financial plan and communicate this methodology to the Budget and Finance Committee and the Governing Board. End of sentence, okay? And if I can add one more comment. The reason I put Budget and Finance Committee and Governing Board is because the first draft plan goes under 3.2, goes to the Budget and Finance Committee by the end of February, and then under 3.3, it's provided to the Governing Board by the end of March. And at that time, then it will also go to the membership. So that's the way I would see it going. Thank you.
So the proposal is that we will retain addition in that verbiage in 3.0 guidelines. The very first sentence is general manager, shall determine the methodology to be used for developing the annual financial plan and communicate this methodology to the Budget and Finance Committee and to the Governing Board. Okay. Do we have any other discussion on this? Okay, let's get consensus on it. First of all, do we feel that there's a need to make the change? Okay. Is the proposed change suggested by Ms. Brown appropriate? I'll read it again. The general manager shall determine the methodology to be used for developing the annual financial plan and communicate this methodology to the Budget and Finance Committee and to the Governing Board. Okay, do we have consensus? Okay, we have unanimous consensus of 7-0 on that. Okay, thank you very much. Oh, I'm sorry.
Just one more statement. I just want to state for anybody who's watching this back that there's no problem currently. We're not correcting a problem. We're just clarifying. Right? So for anybody who's watching, and thanks to the entire team for always making sure the communication is clear.
Well, sometimes this process is kind of tedious and onerous, and so we're living through that right now. Okay, so our next policy is petty cash disbursement, FY20. Mr. Bignato, excuse me, I'm sorry. Bignato.
This is one of the simpler policies. There's not a whole lot here. I reviewed with Dick, and we came to the conclusion that reimbursement for expenses over $100 made on behalf of the association shall be made by check. We felt that that statement should be amended to acknowledge that there are disbursement limits, that if it exceeds $5,000, that it has to have general manager and chief financial officer approval before it can be dispersed, and then it will be dispersed by check. It seemed relatively simple to us. I don't have any further comment on it. If anyone, Dick, back to you.
Frank and I talked about this, and my verbiage is a little bit different. Frank, it's the same premise. Let me read that. So the proposal is to delete under petty cash disbursement 3.0, delete line item 3.2 to delete the line item, and it says reimbursement for expenditures over $100 are made on behalf of the association shall be made by check. That will be deleted, and we insert disbursement limits are established at the department level. Any amount over $5,000 must be approved by the general manager and the chief financial officer and will be made by check. Pete, do you have a comment on this?
Just the check issuance is kind of dating now. We do electronic transfer with 95+%. So if you feel compelled to put that in there, that would be
my
only
1995 mind was at work on that. So I would suggest that we just delete and will be made by check and just leave it, and the payment will be made as the payment is made. Okay, so it will read, disbursement limits are established at the department level. Any amount over $5,000 must be approved by the general manager and the chief financial officer. Stop.
And stop, yeah.
And stop. Okay. So do we all feel that this change needs to be made? There is comment from Cliff.
Sorry. I think the statement is put in there to describe how we reimburse someone if they use petty cash over $100. So I think that's why that statement is in there. So for example, when someone comes to get reimbursed, if they're going to be reimbursed, if it's over $100, they're going to be reimbursed with a check, not with petty cash. That's why that statement's in there. It's just putting a limit on how much petty cash we're going to give someone to reimburse them for a receipt versus how much it's a threshold amount.
Well, the question then that when does a check no longer satisfactory? Does that supplant what we have suggested that we delete check? Because we're implying that, you can pay them any way that, whatever the most appropriate way is.
Well, if you delete that, then you don't have a threshold for the amount of petty cash.
3.1 says we will not have disbursements over $100 from petty cash. And then the second
What
one
I'm saying,
presumes
this
that we
is
are going
saying
to.
that over 5,000, you've got to have the approval by the general manager and the CFO. Doesn't have to do with how it's paid. It's how you need approval.
But the
But I
point is-
think it's about disbursement limits for petty cash.
Yeah,
That's
the
why.
point
That's
is
why.
we shouldn't have $5,000 in petty cash.
No.
So petty cash is limited to $100, and that's it.
I don't think we should change this policy, because if you have $100 in petty cash, I come in with $50. Hey, I want to be reimbursed. You're going to take the $50 out of petty cash and give me cash. Okay. Now, tomorrow I come in and I want $150 reimbursement. You're not taking it out of petty cash. You're going to give me a check.
That's correct.
And I think that's what this policy is about. Just a limit on reimbursing someone. I come in with a $4,000 reimbursement or a $6,000. You're going to get the general manager to approve it, and then you're going to write me a check or do a transfer or something.
Yeah, so we want to discourage people from using petty cash or using their own payment form to get reimbursed. So that's why we put a limit on that. One of the main reasons why we put a limit on that. So you're correct. There's going to be an approval process that we go through for anything for a check, especially one that would be over $5,000.
I don't think we're arguing with that because, yeah, I know that when Frank and I talked about this, when we said disbursement limits are established at the department level, that's because the departments have different limits of approval.
Yeah.
Okay.
Yes.
So, and maybe we're focusing on something else, because this is the mechanics. What this talks about, or what you say this is talked about, is the mechanics of how you're going to get paid. You're going to get either 520s or you're going to get a check.
Yes. So this
Doesn't
is for
yeah.
petty cash transactions.
Petty cash. So are we reading too much in it?
Yes, Mr. Chairman.
Yes.
Mr. Chairman.
Yes.
3.1 says individual disbursement from petty cash funds shall not exceed $100, period, end of conversation. So then reimbursement for expenses over $100 may be made on behalf of the association by check. Yeah, so there's no change. Okay, just, there you go. Well,
Yeah,
Cliff, your point was the intent of this policy is to limit petty cash to $100.
That's correct. Yes.
But doesn't 3.1 already do that? I
Yes.
don't want to beat the
Yes.
dead horse, so I
No, it
think we
Yes,
could
it-
just
it
strike
does.
3.2 entirely.
Yeah, it could just be taken out, 3.2. It just helped to further clarify if you did need petty cash and it was over 100, you're going to have to get a check, not petty cash.
Okay, so let's refocus here and look at just delete 3.2. Do we have agreement on that? We're just going to delete 3.2. Okay, so
Dick, not to get technical, but if it's only one item, then technically it just moves up under 3.0.
and it doesn't change the numbering syntax then. It'd just be 3.0. Okay. Okay. Okay, so we agree to that. Okay, so we have 7-0 on that as well. Okay, that concludes our policy review. I would like to open the floor to the committee for any comments that you may have, and I'd like to start with Ms. Novello.
This was a very technical conversation that we had to have today, and I just appreciate the robust conversation and the fact that everybody was prepared. So, that's all. Thank you.
Mr. Bignato?
Thank you, Dick. I'd like to go back to FI10 if we can, and section 2.2, and the table that follows regarding the amount of purchases.
Wait a minute. FI10. Uh-huh.
I have always had the question and never have gotten an answer. Amount of purchase, 50,000 plus, bidding requirements, sealed bids, purchase approval, governing board. I take that, and I have always taken that to mean that the governing board reviews the bids and makes the approval, but I find no evidence that that has ever happened. And so if someone can help me to understand,
Sure.
does that need to be reworded or?
Maybe. I do get that question, but after the budget's approved, late May, you'll find a facts and findings is presented every year by the general manager that says all the items that you're referencing that exceed $50,000 in either the operating or the capital realm, the governing board with that fact and findings approves him to proceed with that authority.
We've actually seen that a couple times. One, I believe, went directly to the governing board because of the urgency of it, but it may have been withdrawn. And then we've seen it a couple times, I believe.
You know, I know what you're referencing. Those are when they exceed the budget authority.
When it exceeds the
Right,
50,000.
but every year now, I'll be glad to show Frank or any of the committee members, that's a facts and findings. It's on file every single year that grants him that authority to proceed.
Do we have other comments from the committee? No? No? I'd like to invite, oh, I'm sorry, Susan.
Okay, thank you. The presentations were very informative, as well as our discussion regarding the policy changes. I just have one suggestion, and that would be for our next quarterly meeting with CapTrust, that the copies of their statements that were given would be photoed in color. It would be much easier for us to look at and review as opposed to being in black and white. Because many of the charts that they had presented were more meaningful and easier to read if they had been photoed in color, as opposed to see black and white. I mean, that's hard for us to be able to look at. And we find that instead of looking at this, we're trying to look up at the board where they are in color. And I think that's all I had to say. Thank you.
Thank you. Now I'd like to. Pardon? So I'd like to invite anyone in the audience if you have any comments. So if you tell us your name and your rec number, please.
Ed Van Cott, 122253.
Thank you, sir.
This is addressed to the operation and capital modeling questions asked, why do we have reserve funds? Policy mandated? Yes. These funds help avoid special assessment? Yes. Maintain and preserve property value? No. But they may reassure buyers that our services will continue to be funded. Reserve funds are required to sustain the association's recreation facilities. Residents move to Sun City West to enjoy the recreation facilities that add a higher value to their property. They move here to retire. Recreation quality maintains and preserves property value. Residents move to Sun City West for the recreation value offered at an attractive price. While there has always been a vocal few that want lower dues, most residents want to sustain why they moved here. A special membership election was held 10 years ago to vote on 3 bylaw changes that limited governing board actions by making golf and bowling self-supporting, annual budget increases not to exceed 8%, capital projects over $100,000 must be approved by a vote of the owner members. The 3 proposed bylaw changes were defeated as over 80% of the owner members voted to retain the governing board's ability to manage the affairs of the association, which implied continue to offer a variety of member services, programs, and activities and clubs with well-maintained facilities. Maximum 15% dues increases. Reserves are to be used for capital projects, including repair and replacement of current facilities and new projects. Excuse me. The 2023-24 budget faces significant obstacles. Dues were only increased by 3.5% in 2021, 0% in 2022, 2.4% in 2023. Were too low to support the approved operations and capital budgets, and the fully funded reserve balance dropped 6% each year. Too many capital projects were approved, especially when including the over $6 million for Grandview turf removal, while inflation continues at over 8%. The recent increase in Fed interest rates has reduced the number of house purchases. Only 600 annual APF payments were collected during the FY 2009 subprime mortgage crisis instead of the recent average of 1,200. A budget number of 1,100 or less should be considered, as APF receipts are critical. The lower the number, the less reserves should be spent. The solution is easy. The general manager sets budget priorities for all projects from the most needed to the least needed, sets a level of capital spending, and raise dues by 15% from $509 to $585. While a 15% of $76 sounds high, is only a little more than half of the Social Security's average 2023 monthly increase of 8.7% on $1,548 or $134, which follows a 5.9% Social Security increase for 2022. To do less will assure a future owner management assessment. All right, this copy is available if anyone wants it.
Thank you very much, sir. Thank you. That's very interesting. Do we have any other comments from the audience? Okay, our next